Here we are live and in person at the manager selection panel in IvyFON. Hopefully, I haven't lost my voice from all the receptions I went to over the last 3 days, and had lots of fun seeing people I haven't seen, 3 years. So we got a great panel here. This is we really had a good discussion yesterday. I hope we can duplicate it today. So the first thing I think we'll do is give about a 2 or 3 minute introduction about our backgrounds, schooling and prior jobs, what you're doing now, though you get a chance to talk about that in a little bit more detail during the Q&A. But not your fifth grade teacher, I know as much as you like them or you're a teacher's pet. So my name is Gary Sawka, and I met Marty probably about 6 years ago or so, and he's been a great guy. He's had me do about 20 of these panels or so. This is probably the third or fourth on manager selection, so I hope we're getting a lot better. A lot of people know my background. It's all on LinkedIn, but USC undergraduate, HBS MBA. Then I moved up mostly in the financial and operations ladder, corporate venture capital, transportation, leasing, ships, containers, rail cars, financial services, broker dealer, semiconductors, and biotech. So pretty much I can go to any conference and got some expertise one way or the other. So that's my story. I'm sticking to it. I'm going to let Maureen go because she was on here yesterday. She's got a great background.
Oh, well, thank you very much, Gary. My name is Maureen Downey, and I'm a native Californian, but I've probably spent a good part of my life on 3 other continents. My background is that I was a PPE major at Claremont McKenna College, spent some time after then in Latin America and then in Europe. Ended up getting an MBA at Wharton, spent about 10 years in investment banking with Goldman. And then I moved onto the buy side, and I've been in alternatives for the past 15 years, focusing on secondaries and direct investing. Right now, I help lead and manage an investment team for a company called the Beneficient Group, which is a regulated trust bank, which provides liquidity, custody, and insurance services to both investment managers as well as limited partners.
Okay, so I'm going to give Matthew the next shot because he was gracious enough to be the host and give us his wisdom yesterday.
Thank you, Gary. So some of you will be hearing this again. I am a lawyer. I'm the managing partner of the San Francisco and Palo Alto offices of K&L Gates. More relevant to this panel, my clients are investment advisors, fund managers, and investors in funds. And I work with managers to structure vehicles and comply with the securities laws and the Advisors Act. And I'm here to provide, I think, an angle on manager selection, maybe from a due diligence and kind of what we're seeing in the current environment. So I'll leave it there and let you pass it, Gary, to others.
Okay, so Danye, actually, I think it's the first time I've ever seen her in person. Because otherwise she's been, where were you, in a hotel lobby in Tokyo, on the Great Wall of China, somewhere in Singapore,
I've done all that.
Doing the Crazy Rich Asians movie. So give us a little story.
Not really. And Crazy Rich Asian probably overrated. But hi, everybody. Danye Wang. I'm based in New York. I did grow up in China and came to the States for Yale University. And after I graduated in 2008, pretty much in the middle of last financial crisis, I went to BlackRock and worked almost 10 years with the firm. And that was a great ride because I got to see the really transitional progression of asset management industry. And during my career at BlackRock, I was mostly working with Asian institutional investors, central banks, sovereign wealth fund, large insurance companies, national pensions, etc. And then I was briefly an entrepreneur in education technology. I started a company that focused on career development for international talents. Very dear topic to my heart in diversity, inclusion, and advancing your career in corporate America. And then I guess I jumped on the boat for being an entrepreneur. So I started my current firm, UniGlobe Capital, originally as a cross-border advisory firm, but now really morphed into a multifamily office where I work closely with a couple of very large Asian families from China, Hong Kong, and Indonesia specifically, but only with our offshore capital and focusing on deployment here in the US. I would say 70% of my work are through funds, 30% direct deals, and we invest across a couple of different sectors. Venture capital is a big focus, as well as private credit, real estate. I've been spending a little bit of time in public as well, but most of my work is in private for the moment. And I actually do like emerging managers. I like sector specialty funds. Happy to speak more about that later.
Okay, so here we are in Switzerland. Looks like you're in pretty good shape. You must have done some skiing or getting ready for dinner.
Yeah, well, during the holidays, yes, we have done some skiing over here. About my background, I have started my career in investment banking in London with Citigroup. I have been the quantitative leader of Ernst & Young for the South Europe. Right now, I am an adjunct professor in finance in Italy and Switzerland. And I help the Swiss government to take investment decision on innovative companies, as I am an expert at Swiss. So I help to distribute different type of grants. I am also a equity partner of BSMC, that is a pretty big family office. We are in 15 different countries, and we are clearly headquartered in Switzerland. And I am also an entrepreneur in the fintech space, as I have a platform where actually we also digitize and tokenize investment pretty much in the real estate space. So we tokenize financial contracts through the blockchain.
Well, that's a great background. I think you'd probably be pretty good at ordering Italian food too, with that nice accent you have.
Absolutely. Well, originally
I mean,
I'm
I
Italian.
know where to go in Switzerland if that's just great. That's a great accent.
Switzerland has the best of all worlds.
Yeah, I know. So, I talked to a whole bunch of people getting ready to this panel. Most of them were just trying to get some money for healthcare. But 2022, there was lots of ways to lose money. Even if you bought the prior year, those 1% bonds in Google and Microsoft that gave you a rich 25 basis points over treasuries, and now those guys are selling at 60 cents on a dollar. But the best one is, here's my Fortune magazine, and guess who's on the cover? It's this, Fortune's a pretty good magazine, right? But what do they say? They say Sam Bankman-Fried. I don't want to say fried because that only applies to the investors, but it says the 30-year-old billionaire Sam Bankman-Fried is betting big on crypto in a moment of crises. He could build an empire like the Oracle of Omaha. And then as an afterthought, they say, or crash and burn. So that's kind of a great way to lose money instantaneously, right? And so hopefully none of you guys are in that camp. Just hope nobody will admit it. But anyways, so I think that when we look at the first question, what do you think the overall environment is for both the investing in the regulatory? We've got we got Matthew having to leave a little early, so I'm going to let you do it. You did a great regulatory overview, but also in terms of some of both the early and later stage VCs. So why don't you take it from there?
Thanks, Gary. Now the pressure's on, isn't it?
Yeah.
Well, let me try to relay a couple of the thoughts I gave yesterday. And these are really from the perspective of a lawyer that represents early stage managers, hedge fund managers, emerging managers. And what I what I'm seeing are really the following. I'm seeing people interested in private credit, managers interested in forming private credit funds because there's an appetite in the market for investments that are at the higher end of the capital structure, 10, 12%, relatively secure in this environment. The belief is that investors and I would say family offices are looking for an environment where they may want to have a safer place over the next year, something that gives them a yield in this environment, but it's not a time necessarily to be taking big swings. So we are seeing an interest in private credit managers. Secondly, we're seeing quite a few people interested in early stage venture. If you go back to 2008 and 2009, some funds did very, very well investing in startups at the beginning, in the middle of the financial crisis. So we have people looking to form early stage venture, and these are seed stage kinds of funds, micro VC, 50 to 100 million in venture. Conversely, we are seeing some of the larger funds that are pulling back a little bit on later stage venture because valuations haven't reset quite. And people are saying, well, it's going to take a while for those markets to fully pass through. We're seeing a lot of that stress in the market. In our corporate side, mergers and acquisitions and venture capital, the same thing. A lot of companies are looking to extend the runway, use the cash that they have. It's not a great environment for raising new cash. And of course, no one really wants to do down rounds or to be among the first to do that. I think maybe the final point that I'll raise is that at the same time this is all going from a manager perspective, the SEC is in the middle of a very significant uptake in new rules that will have consequences for investment advisors. The marketing rules have changed. There's quite a bit of focus on venture today. Most venture managers are not registered with the SEC. They're exempt, but the SEC is still now looking at them because they're finding there are a lot of errors in how they calculate fees. And so there were 3 enforcement actions against venture managers this year. Secondly, there's a question about the kinds of diligence some of the managers have done going into, for example, FTX. And so I think the SEC will be kicking the tires on some of these managers that are almost blindly investing. Maybe not blinding is the right word, but following others in. And so Sequoia and some others are probably going to get some questions about the diligence that was done in FTX and some of those other places. So I will stop there and happy to answer questions, but Gary, let you pass to some others.
Okay, well, you've got a different perspective, or actually a more broader perspective in terms of some of those issues. Maureen, we talked about it a lot yesterday, but I think your overview would be good too.
Sure. I mean, I guess one thing I would say is I've had the privilege of not only investing, in the U.S., but also in Europe, but also in other regulatory environments, as well as Asia. So I think that one of the things I've seen from a fund perspective, but also from an individual company perspective, because I do direct investing, I really do spend a lot of time thinking or looking at whether or not the individuals at that fund or at that company are respectful of the regulators. Because I certainly, when you look at the fintech space and even other sectors, those companies who haven't been really respectful or try to be aware of regulatory environments are the ones who kind of basically fall by the wayside. I do think that there is kind of a herd mentality. There always is. People do forget what happened, 10 years ago, 12 years ago, whatever you want to call the last cycle. It was surprising, but not so surprising what happened with FTX. I mean, having, witnessed what we all saw with just the momentum behind crypto, and, it never ceases to kind of amaze me sometimes the lack of diligence from even the most sophisticated of investors. So I guess maybe I'll take a step back. I do think that, given, anytime we have, big issues, not only with FTX, but what we saw earlier in the year with, some of the other crypto entities that went bankrupt or came under liquidity, we're probably going to have in the next, I would say 12 to 18 months, a lot of scrutiny upon that sector. Whether or not they're able to make real progress will remain to be seen. I myself did some work early on in 2018 and 19 and looking at digital assets. I built a registered investment advisor actually in digital assets and figured out how to, essentially raise capital via the web and portal. So I spent some time early on, and it's kind of interesting to me that even 5 years on now, we still don't really have real clarity on that. But maybe going back to kind of the question that you originally posed here and kind of the topic of our conversation on manager selection, having been through multiple cycles now, I think this is probably a really interesting time to invest on the primary side with some managers. I think to make those investments, a couple things. One would be to think really clearly about thematically where you think there might be opportunity. Because I think that, given your viewpoint on whether or not we're going to be in I would say a more challenge cycle for 12 months versus 36 months might influence your viewpoint there. But those managers, I think that whether or have the capabilities to come through difficult periods, usually those are really great vintages. I think back to 2008, 2009, the 2010, 11, and 12 primary fund vintages are great. They're some of the best vintages from the decade. To Matt's point earlier, I do think credit is quite attractive now on two fronts. One, rates have gone up quite a bit. You're looking at getting yields, at a kind of mezz structured finance level in the mid to high teens now. And if you put warrant kickers on there, it's even better. And so you have a lot of downside protection. So I think that's a very attractive space to be in right now. Two, if I'm a late stage venture fund and or company, I am not wanting to take financing because the financing is going to come at a much more dilutive round. So I'm probably willing to take some financing from a lender, even if it's at a really high cost, just because one, I may not be able to get the actual equity capital and I may not want to have that dilution. So that's case in point. What I have also seen out there now, because we provide liquidity to entities, be they, individuals or institutional LPs. And folks are struggling quite a bit right now to figure out how to actually value their late stage venture positions. And if they want to get liquidity on it, what is the real price? And so what we have done, at least at Beneficient, is to provide more structured liquidity solutions where we'll be able to share the upside with someone, but then we'll ask for some protection on the downside. So I think for folks that are looking for liquidity or looking for financing, I see a lot of more structured solutions coming out and a lot more creativity in the next 12 months. So maybe I'll just pause there.
Yeah, but maybe just as a quick follow on, in the public markets, you get a bid ask all the time.
Mhm.
In the private markets, guys like appraisers and valuation guys want to keep getting employed. So if there's a 50% markup, are they doing 10% a quarter to kind of break it in? Because they still got to get paid by the client, or do they wait till the check clears before they issue
That's
the
a
opinion?
really complicated question here. Like before this last role that I have now, I actually was a portfolio manager for a 40X fund, and we invested in late stage private growth companies. And so we had to do a daily valuation of the companies of the portfolio every day. We didn't always open the file up on each company, but most of these positions that were held were Series D to Series, say, H. So it's really challenging to mark those large unicorn positions. And right now, I think that is kind of a big question mark out there. So you could be holding a position in, one of the big traditional mutual funds, but it has some late stage private companies in it. How do they mark those companies? Are they in the F round, the G round, or series, preferred series stock? You also see discrepancies across the board from how maybe Wellington is holding it, from maybe where Fidelity is holding it, et cetera. So it's very challenging to do that. Traditionally, in the past, private equity has been slower to mark down positions versus the public market. And you also saw some very creative applications of valuations back in 08, 09, especially when there was a lot of debt on more establish, say, buyout positions that were in buyout companies, because basically if you did a multiples-based valuation, the debt would essentially exceed the equity and the equity would be worth nothing. And so basically people went from doing a multiples valuation to, DCF valuation. I think you're having a little bit of that right now. And I also think too, some of the positions, especially in some of the big funds like Tiger Global or SoftBank, some of them are, we're talking billions and billions of dollars. So if you mark it down 10 or 20%, that has a material impact, on a fund. The other thing I would also say that's kind of, I would say creating some stickiness is the fact that you had a lot of venture funds, early stage, mid stage venture funds who had companies that went public, and instead of distributing the stock or selling the stock upon those companies going public, they held those positions in their funds. So you can say, Roblox would be a good answer, but there's a number of those venture funds that, have held those, public positions in their funds. And now those public positions are worth far less than they were like a year ago. So I think that I've also seen some creativity there, while it's a public position, sometimes we've seen some delays and actually they're being marked to market.
So because there's no markdown, is there an overallocation for like family offices, what percent that they should be allocating, private versus public, percent in a fund, and thoughts on that?
Yeah, it's a good question, Marty. I was actually at a conference a couple months ago. It was a women's conference, and there were a lot of, female LPs, and there were a lot of female fundraisers there. So there was quite an interesting dialogue between the two different constituencies. There is basically an over-allocation currently right now, I guess, to private equity, because the public markets had come down so much last year. And a lot of times when I ask people about private equity too, I'm like, well, is that just what you're committed to? Or is that just what's basically in place now? Because sometimes when people talk about their private equity portfolio, it's just basically what's in their NAV, but not actually what they are committed to as well too. So there is, I think, a bit of an over allocation, and that's causing some consternation. But I think what was more spoken about or more focused on is that every year, if you're being thoughtful about the creation of your alternative portfolio, you have to keep re-upping into those managers that you have in your portfolio. And so now many of the people that are LPs, they have less dollars to allocate. So they're actually having to make even tougher decisions on who gets the re-up, and knowing that if you don't re-up, you may lose access to that manager. And then even if you re-up, but you re-up at only 50%, that may also reduce your access to that manager or access to your allocation going forward. So that was probably, I would say, more of the focus than, gosh, I'm over allocated, I'm going to sell everything, maybe like I did in 2008.
And so many people rely on consultants and advisors for this, that they're just saying, that they don't know it themselves. If you're a family office and made your money in widgets, you're not a financial genius, probably, right?
Mm-hmm.
So you're saying, God, consultant said I should not invest anymore this year or next year because I'm over allocated.
I would say it kind of depends on your advice, where you're getting it from. If you're going to probably one of the bigger consultants who has a track record and have seen this for the last 30, 35 years, they probably have learned something and will probably guide you. If you may be going with someone who maybe alternatives is not their strong suit or maybe less sensitive or knowledgeable, maybe they might, cause you to pull back. The one thing I would also say about family offices that are a little bit different from my perspective than I've seen in institutional investors is that family offices are kind of impacted by the 3 Ds, which is death, demise, your family office blows up, so you need to get liquidity to kind of support the family business. And then the other one that no one likes to talk about, divorce, which doesn't normally affect institutional investors. So many times, at least when I've been dealing with liquidity requests from family offices, they've been driven by different factors sometimes that you don't necessarily see, like from a foundation, endowment, or a public pension plan.
Well, that's great. And Danye, you traditionally the Asian investors probably want twice the ROI or IRR of the people here. So maybe you can tell us how they did last year and what you think they're looking at this year.
I would say in general, deployment has come down. The pace of deployment has come down across the board, especially since the later half of last year. And we anticipate this to continue for at least another 6 months. But I will say that historically, Asian investors, especially those with Chinese origin, may have, relatively speaking, unrealistic expectations on returns. Because back in the days, you can probably blindly invest in real estate in Shenzhen, for example, and generate 30% return, no question asked. But that generation is in the past, and the next 10 years is not going to be the same as the last 10 years. I resonate a lot with what Matt and Maureen has shared. I do want to say most of my work in terms of helping the Asian families to deploy in the US is really help them to differentiate if a manager or even a deal is a good investment versus a mediocre investment, and whether the return profile, the track record was generated based on luck or based on skill. And that goes into a big part of the due diligence work. But in terms of appetite and trend, what I've seen in the last year or so, resonating with what Matt shared, I think private credit became a growing interest for a lot of Asian investors because of the typical shorter duration in fund terms, as well as more stable and attractive return profile for the level of risk they're taking. Because historically, most Asian investors are more accustomed to public equity, venture capital, and real estate, and that's it. And private credit, there's a level of education, especially if your underlying collateral is not real estate backed. But I definitely see a growing trend of a pickup of interest in that sector. And the second thing I want to mention is that size does matter. We all see what happened to the Tiger of the world, the SoftBank of the world. So there's an emerging interest. Instead of only getting access to some of the top tier VC firms in Silicon Valley that has grown substantially in size, there's more prudent appetite in getting better access to emerging managers who have accumulated substantial experience and skill in designated sectors, who have came out to launch new fund, either fund 1 or fund 2. So a lot of my work is to find smaller, more niche managers, but very specialized and really skillful and differentiated and have some sort of a competitive edge or unfair advantage. And that has resonated well with my families. And the last thing I want to mention is the differentiation between getting into funds or direct deal. We talked briefly about FTX. I do know, luckily not my families, but a few families that I'm friendly with have exposure to FTX, and obviously they were wiped on those allocations. And I've had family office friends who got into a Terra Treasury private sale with a 1-year lockup before they also blow up. So people started realizing that there are certain good to have or hot direct deals or late stage pre-IPO opportunities that may not necessarily pan out. And the reason is because family office most of the time don't have the bandwidth to do the actual due diligence. And once an opportunity got so hot or got late stage, typically the deal don't have any incentive to share the detailed financial data or due diligence pack with the family office or the advisors in my shoes. So there's a emerging and very strong appetite for these families now to deploy into funds, especially earlier stage funds, so they can actually get the deal flow early on and follow the progress of certain opportunities, so they can co-invest and bet on direct deal. Not that they don't want to do direct deals, period. They will be more prudent in terms of evaluating where the deal is coming from. Is it from an established relationship, or is the deal coming to them purely because it's too hot, or because the deal can't raise from any other resources? And the last thing I want to say is that although most of my work is related to private market, I do spend a little bit of time on hedge fund and crypto as well. China in general, it's interesting that the panel prior to us mentioned about some of the appetite in going into China public equity, either ETF or active. I would say the high net worth individuals, ultra high net worth, especially family offices out of China, have a slight reverse appetite at this moment because they want to, I guess, at this point of their wealth accumulation, they think a lot more about stability and diversification. So they're more coming out and they want to ensure their US dollar denominated asset actually stay in US asset. But I definitely see a lot of the US asset owners, be it about institutions or family offices, interested in Asia more on the public equity or hedge fund-like opportunities instead of private. Because what we've seen in the last year or two, if we're talking about some of the well-known deals like Ant Financial or DD of the world or ByteDance, exit has been challenging because of the uncertainties with government policies and regulations. So I just want to put it out there for anyone interested in Asia, especially China. It sounds like going into public at this point is a better way to approach the general market opportunity rather than going private.
Okay, so that was a good summary. Mauro, you in Switzerland, I always used to think those guys had their castles for 1,000 years, and so they could look at a lower return but more steady investment that would be there 100 years later, just like the Matterhorn. So are there any kind of alternative investments they're looking at there? Or are they kind of sticking to kind of the traditional things like Nestle's chocolate or whatever?
Well, yes, I mean, I can speak about something pretty specific that is ESG real estate investment trust that we are setting up with a focus on the Italian market that I think is a pretty interesting one right now. In the last few years, also some huge investors as Warren Buffett have targeted the Italian real estate assets. I would say that we have a similar strategy to Berkshire, as we also target upscale holiday properties in top destination. And I believe that right now the real estate can be something interesting on one side because inflation has gone pretty high in Europe. And on the other side, clearly here the critics usually is, yes, but also interest rate have gone high. But for a top luxury location, interest rate has, let's say the price is less sensitive to the selling procedure is less sensitive to interest rate. And furthermore, we are focused mainly on restructuring and renovation projects because we can benefit from the tax deduction offered from the Italian government for energy efficiency measures and reduction of seismic risk of building. And in this way, we are not only able to qualify the strategy and the real estate investment trust as an ESG, but also we can target a return that are above 80% for every project because with the benefits that we are able to get from the tax reduction, we can cover almost 50% of the total cost of the project. Right now we have 3 projects, 2 that are in Courmayeur, that is the second most exclusive ski resort in Italy. One is small, around 10 millions, another one is a medium, around 20 millions. And one big project that is in Cortina d'Ampezzo, that is the most exclusive ski resort in Italy, that in 2026 will host also the Winter Olympic Games. For this particular strategy, we are also selecting a manager that will help us in managing the assets that we have and that we are going to develop. Clearly, this is something pretty complex because I mean the selection of the manager is a pretty complex procedure because we need someone that is not just skilled with the real estate investments, but we need someone that really understand what the ESG criteria are and how to embed them in an investment strategy. And also we need someone that will be able to deal with the Italian rules and regulation on tax deduction that are not easy at all. But we think that this for this cycle, we believe we are at the beginning of a new cycle. So we are we pay attention on how we invest. We are pretty opportunistic. We try to scout and fund some new strategies. We believe that this might be a really good opportunity for us.
Yeah, so we're going to move on to a few more topics, but we got a quick question from the audience about whether Italians care about ESG, or they're mostly looking for the tax benefits. Quick question, and I'm going to move on. Quick answer.
Sorry, can you repeat the question, please?
Oh, the question is, do the Italians care about ESG or the tax benefits on all these projects? Yeah. Well, the Swiss, he's talking about the Italian, so this always is Italian.
So we are based in Switzerland, but this real estate investment trust will target Italian real estate assets. Right now, the Italian government launched a huge program for optimization of energy efficiencies of real estate assets in Italy and a reduction of seismic risk. So I would say every type of restructuring or renovation projects can benefit from this tax deduction. And the good thing is that the tax deduction that we get as a benefit can be resold to other funds. There are special funds that buy this type of tax deduction, and then they will resell it to enterprises. So made of 100 euro of cost, around 50 euros can be covered with the tax deduction benefits from Italian government. So we can at least double the normal return that we have on a real estate project.
Yeah. So I think that because so many of these people here are people that aren't going to go into these very narrow niches, even though that's a great deal if I would have learned Italian when I was growing up. But I think the audience would like to hear from each of you in succession about what kind of year did their private managers have, and are they really looking for more liquid investments or less? Do they think it's going to turn around in the next couple of years?
I have a couple questions for Matt, because I think it's real regulatory oriented.
Okay, yeah.
Matt can answer them, they're pretty important. So, being in this space, there was the Obama Jobs Act, which really kind of liberalized investing in a lot of ways. Right, you had people who no longer had to qualify monetarily to become accredited investors. You could do based on education. There's an explosion in crowdfunding, right? You got NFTs, and a lot of so NFTs created. Crowdfunding is not the people who invested in crowdfunding didn't do well. Most people who invest in crowdfunding don't know that about 30% of the money they invest to goes towards funding the campaign.
Yeah.
Right. One thing you hear about all the time in crypto and other venture capital, especially early stage or venture capital deals, is who's in the syndicate. Before you ever hear about due diligence, like nobody ever talks about, I mean, I've never heard due diligence mentioned in early stage investing, right? But I always tell people, well, if you're looking for $10 million, you should have due diligence, or you should at least know what the marketplace is, right? So any thoughts on like the regulatory approach towards that? Because I mean, we see that these places used to exist, they're just crowdfunding. It's down 90%, right? Crypto is down 70%. A lot of crypto is just gone. Co-investing, no due diligence, who's in a deal syndicate? I mean, that's like so there's like all these behavioral psychology investing approaches.
Well, it's an interesting issue. We may have just passed the era, the FOMO era, the fear of missing out era. Everybody's doing it, and if I don't do it, I'm going to miss out on this. And I think it's a corollary to that is what Maureen mentioned, this notion, if I don't invest in this fund, I'm not getting in their next fund, and this is the best manager, and my God, I've got to just do it. And then you're right, in Silicon Valley, club deals, hey, so-and-so's in there. And so in some way, people say, hey, listen, it works out over time. There's some winners and losers. But I think there is a bit of a reset right now about what are we looking at. there was a regulation by enforcement comment earlier. That's true. That's how the SEC is going out about it. There's also something pretty interesting happening. The SEC has proposed a rule that would change the fiduciary duty or would take out the ability for investment managers to have a gross negligence standard for selecting investments and require a negligence standard, which may increase the risk for every fund manager out there and making investments and then mean that they're less willing to make certain investments. They're going to be more careful. I think this rule the venture community hates this proposed rule. I don't think it's going to happen, but it is it would be a sea change imposed by the chair of the SEC on a wide swath of managers out there to actually take away the freedom of contract and say you must have a negligence standard and not a gross negligence standard. So it could be interesting.
And any thoughts on that? I mean, so what happens? I've talked to a lot of different fund managers. VCs who come to you, they don't. A lot of them don't. The right Combinator alumni. They don't have fantastic networks for investors. Others have very astute investors who can take losses, right? I mean, does that cross anybody's path? Like, how sustainable is the investment community behind each fund? Because there is this kind of, you can lose everything perspective.
Well, there's two things I would say. One is, to me, I like this concept of negligence because I do think there's a huge herd mentality. And a lot of times I think there's just sheer laziness that goes on in the investor community, be you investing in a company or be you investing in a fund. You're like, who's the reference investor? Did somebody else do the work? Because I don't want to do the work. If they're in, then I don't have to do the work. And by the way, I can just put that into my investment committee memo. And that's just not a good way to invest. So the second thing on the, I think there should be alignment too. When you're putting together a fund or you're putting together a package of investing for a company, I always look at the alignment. I want to make sure that whoever I'm giving money to has some skin in the game and that if they win, I win. I have no problem giving up more upside, to somebody because I figured if they make the pie bigger, we're all going to come out better. So I think alignment, that's to me what private equity, venture capital, alternative investing is about. It's about alignment. And that is what you always really should be, quite focused on. And then I would say last, in terms of just on the regulatory side, well, to your last question, I would say on the investor side, a lot of it's just your network and who you know. And that's how a lot of these funds get raised. So a lot of times when people talk about, we don't have, as many women or people of color, involved in this community, I would say, to some of that, it's down to access, right? And sometimes people say, well, these particular populations have better returns. And having spoken to some of them, I think some of it is because it's taken them such a long time. It's been so hard for them to raise the capital. They spend a lot of time doing, or trying to do a better job. But, I think a lot of it comes down to access and the network. And if you do want to, frankly, make sure that there is maybe a higher chance of more funds getting better returns, it's also kind of broadening that access to different investors that different, managers have, but also making sure that when they do get to the table, you apply, I think, a more, I don't want to say formulaic, but a more rigorous form of due diligence, because that is very hit or miss.
It's just
Sorry.
remarkable people who are raising large sums of capital and don't know what the marketplace is. It's a remarkable occurrence.
But in terms of that, Matthew, maybe I'm pretty old school, but when I looked at Mr. Freed and his two lieutenants, and I said, would I put anything in, 3 30-year-old vegans? I mean, it doesn't make any sense. I mean, or this illusionary NFTs on illusionary San Francisco properties for a land grab. I mean, okay, you can claim Farm Bill for a few dollars, but and a lot of these things have gone down 90%.
Right.
So, and when we had the last crypto, my mention was you guys have a good view of crypto because you invested at $400. But how about those poor guys, who watched the Super Bowl commercial and, they bought it at 69,000.
Well, the crypto issue is that a lot of the people who invested at $400 are also the people who staked new tokens and new coins.
Yeah.
And so there's a conflict of interest because there's on the one side they're staking it and they're getting a half price, once it's distributed, they sell out. They go
So
back.
I think we look through history and you look at Madoff and you know, I go back to Warren Buffett, bless you. Warren Buffett and Charlie Munger, what they said about crypto, and they kind of seemed like they were out of it for a period of time, you know. And I think this notion of independence and stepping back and saying, do I really understand this? Do I understand the process? Even though everybody thinks it's the great thing, I think independence is really, really important.
Yeah, one question that came from the audience is, if fund managers who invested on behalf of the LPs, and they invested in things like FTX with zero due diligence, can they be sued? Or will they be required to provide the due diligence they did, or anything?
They can always be sued. That is, will they prevail? I mean, I do think there'll be tires kicked on that from the plaintiff side and from the regulators. Whether they prevail is a kind of an open case, but for sure there will be management. I mean, Sequoia lost 125 million, Thoma Bravo, large sums. We'll see, but those are also a lot of venture investors understand that, you know, it's a 1 out of 10 game and certain things are expected to go down to loss as well.
Danye, do you think the Asians were too smart to invest in all this crypto stuff? Because they're, you know, you see them all at the baccarat tables and other things. And they're kind of gamblers in some respect in Macau, right? So what do you think about them and all these alt investments?
I would say in general, some Asian investors are speculative in nature. I've seen 0% of allocation to crypto. I've seen up to 10% allocation to crypto. I've seen people, not my families, but people who have essentially accumulated their wealth through tech or gaming or crypto. In general, they're all in crypto Web3 still. So I guess there's a saying in the industry, if you know a family office, you know a family office. So people really come from very different background and appetite in this. But I do want to say that family office versus any other institutional LP types is that they don't have the pressure to deploy unless they're facing the 3Ds that Maureen mentioned. They don't have the pressure to deploy. It's not like they have to behave like a VC or fund structure, as in there's an investment period of say 3 to 4 years that they need to deploy. If they see a good opportunities, they can be very aggressive and they can make decisions very quickly. Or if they don't see a good opportunity, if they're not comfortable, they don't have to invest for a long time, which is why I think it's important for deals and funds to understand this dynamic when they're communicating to families, because they don't necessarily respond well to pressure unless the family really want the opportunity, and then they would move very quickly. But I do really resonate with what Maureen said about alignment. I definitely have a lot of respect for GPs who have done 10% GP commitment out of their fund versus a 0.5% or 1%, while the GP partners themselves have made significant money. So that is very, very important. And on due diligence, what I do want to share, and maybe all of you guys in the audience can help someone like me, is that Asian family offices actually, in terms of their way of conducting due diligence, especially for US-oriented opportunities, be it about funds or deals, is challenging. There's the time difference, cultural difference, language, sector a difference. They may have a lot of touch points in Asia where they can easily pick up the phone and understand the holistic story of a deal or a fund and do manager background checks easily. But when they come to the US, even some of the most prominent family offices don't necessarily have good access or reference points and touching point here in the States. So they do rely on someone like me and my extended network to do that. And a lot of times I have to provide ODD and other due diligence materials, either from myself or other lead investors, because they simply just cannot conduct the work themselves. So it's not that they don't want to, but because they don't have the capability, or there's a bandwidth challenge, or there's lack of touch point. But yeah.
Okay, so I don't know how much time we have, because I see a couple hands up in the audience.
Why don't you ask them the question?
Okay, so Rob, how about a question? Or I'll repeat it if they can't hear it.
That's fine. Rob Cohen. Maybe Matt leads, but whoever else wants to chime in. On the crypto part, Matt, you guys have an office that's 2 blocks from the White House. How should Washington address regulation here And then I'd be interested from the commercial side of not overstepping.
Yeah, well, real quickly, will the SEC get some rules in place or will we have regulation by enforcement? And I think what I'm hearing is, even though they should have a comprehensive investment program that has broker-dealer like rules and seeks to deal with some of these setups that have had problems at FTX and others, that it's going to be challenging. It's not on their rule set of proposals right now. It doesn't look like it's going to happen in the next year. So I expect regulation by enforcement. And we're starting to see that. Everybody's waiting to see what happens with a case, the SEC versus Ripple, and because that's an early, question about many of these cryptocurrencies, digital currencies, are they securities or not? And there could be a sea change after that. So I'll pass this to some others. Thank you, everyone. I need to run for another call.
Okay, thanks a lot. So I think we'll go back to the question. Another question?
I just wanted to comment about what you said about the way that LP, I wanted to just comment and say that diversification is everything. Even as a family office, you can choose either to be an LP or invest directly. And you see a lot of the family offices investing directly too. Pretty common. At the same time, I understand that there are some buzzwords out there, like the gentleman mentioned the fees and et cetera. When Jeff Bezos was talking about Amazon, nobody wanted to invest in it. But it is still a decacorn today, right? So what I'm trying to say is that the ease of investment is detrimental for innovation. So the harder we make the investments, it'll be harder to innovate at the end of the day. And in between, there will be some losses. You cannot have the upside without the downside. But diversification is a key. So we choose to do both or all of them in a conscious way. The understanding that we will lose some of it and we will win.
I think everybody believes in diversification, but I'm going to tell you a quick story if Marty doesn't mind. We in HBS and when I was going there, we put together for Section D a Delta fund, and one of the guys was a guy who had been a child actor, Michelle D. Carvalho, and so he says, "Why believe in putting all the eggs in one basket and watching that basket?" So I didn't remember it until later on. I found out that he had married Freddie Heineken's sole daughter, Charlene, and now has, when Freddie died, has 40% of Heineken's worth $6 billion. So he's obviously watching that basket real closely. And he's one of my most prolific writers because I'm class note secretary.
Right,
but
so I think
that's one thing, yeah.
The portfolio management perspective is that you want to diversify to the point where you get risk adjustment. This is the way he said it important, but you don't want to over
It's the efficient
diversify.
frontier.
Right. Efficient frontier. So, and that can be reached with an investment pool of 12 to 20 investments. You don't need to invest in 100 NFTs or 100 tokens, et cetera, right? So you have to be very careful about that. And then you have to look in detail, because I think the lesson of the .com crash was that the VCs had overinvested in too many things.
And then what they had done is they had kind of like set up a system of credits while they creating any revenue and they just created this
over-escalating, overvaluing dynamic, which is the same thing happened in crypto. When all this comes out
in the crypto space and the trading of crypto, they're going to find out that they had all of these games that they were playing where one company was selling to another company, the price went up and they sold it back, and they kept it going back and forth. So you're going to have over-diversification.
Makes you think, to your point, one of the things that's always struck me about family offices and maybe why they've been more inclined to invest directly is that they need a higher return. They're looking for more alpha. Whereas when a pension fund or maybe to a lesser extent an endowment invests, they are looking for maybe a more secure return, maybe less alpha, but more diversification. But one big thing that I think a lot of people forget is that family offices pay taxes. Endowments, foundations, and pension funds don't pay taxes. And so somebody with a big buyout investment into like a KKR or Blackstone getting like a 1.7, 1.6 is fine. But if you're paying taxes on that, it doesn't really work as well for a
I
family
just want to
office.
add another comment, which is the rate of inflation for the general population is about 8%. The rate of inflation for family offices and their cost of living is around 15 to 20%, right?
But they can afford it.
Well, the rate of inflation is the rate of inflation, but you're becoming impoverished by
And they're giving back to the system.
it. Okay.
I would say when choosing managers, I think about either you're a spray and pray model, you may invest in like 100, 200 deals and expect one or two of them to really blow up, or you are a more concentrated manager where you really focus on certain segments and you truly help the entrepreneurs to grow, where you provide significant value add and really help the full cycle of operations all the way to exit. So I think I personally like the concentrated bet. Not to say they're not diversified, but they're very focused on their investment. And the other thing I want to make to your point is that at least for the Asian managers, Asian families that I have been working with for the last couple of years, there's a trend to move not necessarily away, but from an allocation perspective, proportionally from direct deals to more fund allocation, precisely for the reason of diversification. And also for any family offices who want to do more direct deals, I would ask them the question, do you have the right team and the infrastructure and the process to do it? If not, maybe your initial step should be to do funds, and then you can do co-invest or learn from the managers, and over time you can go direct, but the initial step should really be fund allocation.
So if I can say something about the crypto that I know very well, because I am into this technology since 2016, and I have one of the few platform approved European digital asset exchange here in Europe for offering a primary and secondary market on security token. I think there is still a lot of confusion about what is this technology and what are NFT and cryptos. From time to time, I hear I am investing in NFTs. That does not make any sense, because an NFT is a contract. So it's like to say I am investing in contracts, but what does that NFT is representing? Is it representing a digital art piece, or is it representing a property house, a physical property house somewhere, or maybe a property house in the metaverse? What is that token representing? Is representing a shares? For example, here in Switzerland, we have the possibility of tokenizing shares of companies. So is that token representing shares of a real company, or is representing a new fancy startup with a strange project in the crypto world? So I really think that we are entering in a new era, in a new phase where you need to make some due diligence in understanding what is that NFT or what is that token, what they are representing, and what is the contract behind that token. Because blockchain is just a technology, and I think that the parallelism with the .com in 2000 is it makes a lot of sense. In 2000, everyone was investing in projects just because they were internet related, but it doesn't mean that the project is good. You really need to understand what is the use case of that token, or in case of the blockchain, to understand if the project is good. And I think that up now, the problem was a speculative bubble. Everyone was investing, just hearing the magic word NFT or blockchain, and this has created a big bubble that I think will change in the short term.
So Gary, we have about 30 seconds for each person.
Yeah, we got about 30 seconds. Mario, if you speak anymore, I'm getting really hungry with that Italian accent. So I think you've given us a good summary. No, it's true. I mean, it's true. I think we've got a good summary from everybody except for Maureen. And so why don't you give us about a 30-second to 1 minute summary of what do you think you want give as a takeaway for this whole meeting?
Oh, I guess, well, first and foremost, I think if your whatever your investment theme is, kind of depends on your objectives, right? And then two, your capacity. I think Danye mentioned that. And, three, your view on what you think, the environment's going to be like in the next 3 to 5 years. And I'm happy to have a conversation with anybody afterwards. I don't want to hold anybody up for either coffee or lunch.
Okay. Fantastic. Oh, yeah, last question?
Yeah, one quick question to Maureen and Danye. I know the investment dynamics for institutional investors different from the family offices, but have you had any issue in terms of access to good investment opportunities with good fund managers that lose out to the family office or the other way around?
No, usually the other way around. So I spent about 10 years as part of a partner as a multi-billion-dollar fund-to-fund platform, and very different access. But if you're a GP and you're raising your first, second fund, usually you're hitting up the family offices or the ultra high net worth, base. The other thing I would say is the fastest growing part of the alternative capital base now are ultra high net worths, be they 0 to 5 million or 5 to 25 million. And everybody knows that in the space, especially the big GPs that are looking to raise capital. So it's going to change.
I would say most of the family offices already have access to some of the best private banking, and through that they have access to some of the brand name PE managers, mutual funds, whatever it is. So when family offices start their own single family office or really go through multifamily, they want some more differentiated strategies or hard to access funds. Some of the pension funds or maybe newer established endowment foundations may not necessarily have access to those funds either. So, but I would expect the return profile they're looking for those access will be higher.
Okay, Marty,
Okay.
thanks for the opportunity. You wrap it up and we'll go to the next one, huh?
Fantastic, Gary. Great job.